Dear students, welcome to SWAYAM Massive Open Online Course Public Financial Administration. I am Dr. Vijayakumari Joseph, Associate Professor, Department of Commerce, Madras Christian College, Chennai. In this video, I will be presenting about firms, insurance companies, investment banks and commercial banks. By the end of this video, you will be able to understand what firms, insurance companies, investment banks and commercial banks and how they are functioning. Let's first learn about firm. A firm is an organization which sells or produces something or which provides a service with the aim of making a profit. In other words, firms can also be called as company, business concern, association or enterprise. A firm may use natural capital or people related resources to generate operational success. A business entity such as corporation, limited liability company, public limited company, sole proprietorship or partnership that has products or services for sale, which is known as a firm. Law, accountancy and management consultancy partnerships are known as firms and are rarely referred to as companies. Theory of the firm. The theory of the firm refers to the microeconomic approach devised in neoclassical economics that every firm operates in order to make profits. Companies ascertain the price and demand of the product in the market and make optimum allocation of resources for increasing their net profits. Let's now look into the types of the firms. There are various types of firms. The three main types of the firms are sole proprietorship, partnership and joint stock company. Sole proprietorship. Have you ever gone to buy a pen or a pencil, eraser, sharpener, etc. from a small neighborhood stationery store? Well, in all probability in the course of your transactions, you have interacted with a sole proprietor. Sole proprietorship is a popular form of business organization and is the most suitable form for small business, especially in their initial years of operation. Sole proprietorship refers to a form of business organization which is owned, managed and controlled by an individual who is the recipient of all profits and bearer of all risks. This is evident from the term itself. The word sole implies only and proprietor refers to owner. Hence, a sole proprietor is the one who is the only owner of a business. This form of business is particularly common in areas of personalized services such as beauty parlors, hair salons and small scale activities like running a retail shop in a locality. The owner is personally responsible for payment of debts in case the assets of the business are not sufficient to meet all the debts. Salient characteristics of the sole proprietorship form of organization which are as follows. Formation and closure. There are no separate law that governs sole proprietorship. Hardly any legal formalities are required to start a sole proprietary business, though in some cases one may require a license. Closure of the business can also be done easily. Thus, there is ease in formation as well as closure of business. Liability. Sole proprietors have unlimited liability. This implies that if they had bought in rupees 20,000 from their personal source, if the business incur loss, the sole proprietor has to pay it even if they have to sell their personal property to repay the firm's debts. Sole risk bearer and profit recipient. The risk of the failure of business is borne all alone by the sole proprietor. However, if the business is successful, the proprietor enjoys all the benefits. He receives all the business profits which become a direct reward for his risk bearing. Control. The right to return the business and make all decision lies absolutely with the sole proprietor. He can carry out his plans without any interference from others. The next type of firm is partnership. A partnership is a type of business where a formal agreement is made between two or more people who agree to become co-owners, share responsibility for running the organization, and share any profit or losses arising from the business. In India, all aspects and functions of partnerships are governed by the Indian Partnership Act 1932. The Indian Partnership Act 1932 defines partnership as the relationship between persons who have agreed to share the profit of the business carried on by all or any one of them acting for all. Features of partnership. Formation. The partnership form of business organization is governed by the Indian Partnership Act 1932. Liable to the extent individually to each partner can be held responsible repaying the debts of the business. However, such a partner can later recover from the other partners an amount of money equivalent to the shares in liability which is defined as per the partnership agreement. It comes into existence through a legal agreement wherein the terms and conditions governing the relationship among the partners, sharing of profits and losses, and the manner of conducting the businesses are specified. It may be pointed out that the business must be lawful and run with a motive of profit. Thus, two people coming together for charitable purposes will not constitute a partnership. Liability. The partners of a firm have unlimited liability. Personal assets may be used for repaying debts in case the business assets are insufficient. Further, the partners are jointly and individually liable for payment of debts. Jointly, all the partners are responsible for the debts and they contribute in proportion to their share in business. Risk bearing. The partners bear the risk involved in running a business as a team. The reward comes in the form of profits which are shared by the partners in an agreed ratio. However, they also share losses in the same ratio in the event of the firm incurring losses. Decision making and control. The partners share against themselves the responsibility of decision making and control of day-to-day activities. Decisions are generally taken with mutual consent. Thus, the activities of a partnership firm are managed through the joint effort of all the partners. Continuity. Partnership is characterized by lack of continuity of business since the death, retirement can bring an end to the business. However, the remaining partners may, if they so desire, continue the business based on a new agreement. Number of partners. The minimum number of partners needed to start a partnership firm is 2. According to section 464 of the Companies Act 2013, maximum number of partners in a partnership firm can be 100 subject to the number prescribed by the government. As per Rule 10 of the Companies Rules 2014, at present the maximum number of members can be 50. Mutual agency. The definition of partnership highlights the fact that it is a business carried on by all or any one of the partners acting for all. In other words, agent of other partners as he represents them and thereby binds them through his acts. He is a principal as he too can be bound by the acts of other partners. Lastly, let us look into joint stock company. A company is an association of persons formed for carrying out business activities and has a legal status independent of its members. A company can be described as an artificial person having a separate legal entity, perpetual succession, and a common seal. The company form of organization is governed by the Companies Act 2013. As per section 220 of Act 2013, a company means company incorporated under this act or any other previous company law. The shareholders are the owners of the company while the board of directors is the chief managing body elected by the shareholders. Usually, the owners exercise an indirect control over the business. The capital of the company is divided into smaller parts called shares, which can be transferred freely from one shareholder to another person. Features. The definition of a joint stock company highlights the following features of a company. Artificial person. A company is a creation of law and exists independent of its members. Like natural person, a company can own property, incur debts, borrow money, enter into contracts, sue and can be sued, but unlike them, it cannot breathe, eat, run, talk and so on. It is therefore called an artificial person. Separate legal entity. From the day of its incorporation, a company acquires an identity distinct from its members. Its assets and liabilities are separate from those of its owners. The law does not recognize the business and owners to be one and the same. The formation of a company is a time-consuming, expensive and complicated process. It involves the preparation of several documents and compliance with several legal requirements before it can start functioning. Incorporation of companies is compulsory under the Companies Act 2013 or any of the previous company law as stated earlier. Such companies which are incorporated under Companies Act 1956 or any company law shall be included in the list of companies. Perpetual succession. A company begins a creation of the law can be brought to an end only by law. It will only cease to exist when a specific procedure for its closure called winding up is completed. Members may come and members may go, but the company continues to exist. Control. The management and control of the affairs of the company is undertaken by the board of directors, which appoints the top management officials for running the business. The directors hold a position of immense significance as they are directly accountable to the shareholders for the working of the company. The shareholders, however, do not have the right to be involved in the day-to-day running of the business. Liability. The liability of the member is limited to the extent of the capital contributed by them in a company. The creditors can use only the assets of the company to settle their claims, since it is the company and not the members that own the debts. The members can be asked to contribute to the loss only to the extent of the unpaid amount of share held by them. Common seal. The company, being an artificial person, cannot sign its name by itself. Therefore, every company is required to have its own seal, which acts as official signature of the company. Any document which does not carry the common seal of the company is not a binding on the company. Risk bearing. The risk of losses in a company is borne by all the shareholders. This is unlike the case of sole proprietorship or partnership firm, where one or few persons respectively bear the losses. In the face of financial difficulties, all shareholders in a company shares in the company's capital. The risk of loss thus gets spread over a large number of shareholders. I hope you all would have learned about firms. Let's next learn about insurance companies. Before getting into what insurance company is, let's first see what insurance means. Insurance is protection against monetary loss in exchange for one party agreeing to compensate the other in the event of certain loss, damage or injury. It is a form of risk management primarily used to hedge the risk of unexpected or uncertain losses. Businesses that provide insurance are known as insurance companies. Insurance companies, insurers or underwriters. The individual or organization that has taken out insurance is called the insured, and the individual organization that has taken out insurance is called the insured. In simple words, insurance is a way to manage your risk. When you buy insurance, you purchase protection against unexpected financial losses. the insurance company pays you or someone you choose if something bad happens to you. The company which provides the people with insurance coverage can be called as insurance companies or the insurer. Some example of Insurance Company of India: Life Insurance Corporation of India, HDFC Life Insurance Company Limited, Max Life Insurance Company Limited, Bajaj Alliance Life Insurance Company Limited, SBI Life Insurance Company Limited. Insurance coverage has the following salient features. It is a kind of risk management plan to use an insurance policy as a hedge against an uncertain loss. Insurance coverage does not mitigate the magnitude of loss one may face. It only assures that the loss is shared and distributed among multiple people. Various clients of an insurance company pool in their risks, hence they pay the premium together. So, when one or few incur a financial loss, the claimed money is given out of this accumulated fund. This makes each client bear a nominal fee. Insurance coverage can be provided for medical expenses, vehicle damage, property loss, damage, etc., depending on the type of insurance. Premium policy limit and deductible are the main components of an insurance coverage policy. The policy buyer should check them thoroughly while buying an insurance policy. The common types of insurances are health insurance, life insurance, travel insurance, motor insurance, general insurance, etc. Benefits of insurance: financial security, provides protection, risk sharing, provides certainty, return on investment. Investment bank. Investment banking is a specialized branch of banking that helps individual or organization raise capital and provide financial advisory services. Investment bankers raise money from investors by selling securities, then transfer the money to people who need the cash to start a business, build a building, manage a city, or pursue other high value projects. They act as intermediators between insurers of security and investors and help new companies go public. They neither buy all available stock at a price estimated by expert and resell it to the public, or sell stock on behalf of the insurer and charge a fee per share. Investment banking is among the most complex financial mechanisms in the world. They serve many different purposes and business entities. They provide various types of financial services such as proprietary trading or trading securities for their own accounts, mergers and acquisitions advisory, which involves helping organizations in mergers and acquisitions, leveraged finance that involves lending money to firms to purchase assets and settle acquisitions, restructuring that involve improving structures of companies to make a business more efficient and help it make maximum profit, and new issues or IPOs where these banks help new firms go public. Some example of global investment banks: JP Morgan, Goldman Sachs, Citigroup, Bank of America. The services offered by investment banks typically fall into one of a few buckets. One of the best ways to understand investment bank is to examine all the functions that some of the investment bank performs, like capital raising. Companies and organizations generate money from investors. This is typically done by selling shares of stock or debt. Financially advisory. In this role, the investment banking operation is hired to help a company or government make decisions on managing their financial resources. Advice may pertain to whether to buy another company or sell off part of the business. A common business decision tackled by this type of investment banking is whether to acquire another company or divert of a current product line. This is called mergers and acquisitions. Corporate lending. Investment banks typically help companies and other large borrowers sell securities to raise money. But large investment banks are also frequently involved in extending loans to their customers, often short-term loans to tide a company over while another transaction is in the works. Sales and trading. Investment bankers are a creative and innovative lot in the business of constructing financial instruments to be bought and sold. It's natural for investment bankers to also buy and sell stocks and other financial instruments either on the behalf of their clients or using their own money. Brokerage services. Some investment banking operations include brokerage services where they may hold clients' assets or help them conduct trades. Research. Investment banks not only help large institutions sell securities to investors but also assist investors looking to buy securities. Many investment banks run research units that advise investors on whether they should buy a particular investment. The term investments and securities are pretty much interchangeable. Investments. Investment banks typically serve the role of a middleman sitting between the entities that need money and those that have it, but periodically units of investment banking operations may invest their own money in promising companies or projects. This type of investment, often made in companies that don't have investments that the public can buy, which is called private equity. Investment banking operations at one firm may be engaged in some of the preceding activities, but not all. There is no rule that demand investment banking operations must perform all the services described here. As investment firms grow, though they often add functions, so they are more valuable to their clients and can serve as a common source for a variety of services. Types of investment banking operations. Insiders in the investment banking business use all sorts of terms, some decidedly derogatory, to classify the players in the business. Some classifications that investment banks fall into these following brackets. Bulge bracket investment firms aren't the ones that ate too many slices of cheesecake. Instead, bulge bracket is a commonly used slang term to describe the biggest of the big firms, are the behemoths like the ones they have in their hands in most of the investment banking. Boutique investment firms are smaller investment banks and traditional banks that choose to focus on one or select few areas of the business. Some firms, for instance, focus on selling securities for smaller companies. Regional firms typically focus on a particular part of the country, whereas the bulge bracket firms continually try to grow and take market share from rivals. There seems to be plenty of rooms for smaller players like these. Some regional firms also often concentrate on a particular type of investment banking service, be it trading service or underwriting of securities. Let's see how investment banks get paid. As you can imagine, although investment banking plays an important role in funding economic progress, there is also lots of money to be paid. Investment bankers can't afford those fancy suits if they are not getting paid. Investment bankers perform services for customers and collect money in several ways, which include the following. Commissions. Investment banks sometimes collect fees in exchange for conducting financial transaction between a buyer and seller. One of the more common forms of commissions is often collected in the brokerage operation by some traditional banks and investment banks. For instance, Merrill Lynch, the brokerage and investment banking unit of Bank of America, charges commissions when purchasing stock for its customers, but that's just a small example. Underwriting fees, a lucrative area of investment banking which generates fees for selling securities in the primary market. When a company sells stocks to the public for the first time, for instance, the investment banker who handles the deal, called the underwriter, collects a fee. Trading income. Investment banks usually handle other people's money, but many investment banking operations also include a trading division. This unit attempts to take advantage of temporarily mispriced financial instruments. This high risk proprietary trading is designed to generate profits for the firm. Asset management fees. Some investment banks help their clients make decisions on how to invest their money. Investment banks generate asset management fees when they help clients decide which securities they should buy or sell. Advisory fees. Companies often look to their investment banks for advice, especially in the case of M&A deals. And in these cases, the investment bankers are brought in to provide in-depth numerical analysis of a proposed deal. The companies pay substantial fees for this high-level assistance. Commercial bank definition. Accepting for the purpose of lending or investment of deposit money from public, repayable on demand or otherwise, and withdrawable by check, draft, order or otherwise, according to Banking Company Act of 1949. In general, commercial banks are profit-seeking business firms dealing in money, or rather claims to money. Commercial banks play an important role in the economic development of any country. The business of a commercial bank is primarily to accept deposits and advance short-term loans. Apart from this, a commercial bank performs several other useful functions to the community. Every commercial bank gets its funds mainly from three sources: share capital, reserve fund, and deposits from the general public. Various banking systems came into existence with the development of banking in the world. The two most distinctive features of a commercial bank are borrowing and lending, that is, acceptance of deposits and lending of money to project to earn interest. In short, banks borrow to lend. The rate of interest offered by the banks to depositors is called the borrowing rate, while the rate at which banks lend out is called lending rate. The following are the functions of commercial banks. The functions of commercial banks are classified into two main divisions. Primary functions: accept deposit. The bank takes deposits in the form of saving, current and fixed deposits. The surplus balances collected from the firm and individuals are lent to the temporary required of commercial transactions. Provides loan and advances. Another critical function of this bank is to offer loans and advances to the entrepreneurs and business people and collect interest. For every bank, it is the primary source of making profits. In this process, a bank retains a small number of deposits as a reserve and offers the remaining amount to the borrowers in demand loans, overdrafts, cash credit and short-run loans, etc. Credit cash. When a customer is provided with credit or loan, they are not provided with liquid cash. First, a bank account is opened for the customer and then the money is transferred to the account. This process allows a bank to create money. Secondary functions: discounting bills of exchange. It is return agreement acknowledging the amount of money to be paid against the goods purchased at a given point of time in the future. The amount can also be cleared before the quoted time through a discounting method of commercial banks. Overdraft facility. It is an advance given to a customer by keeping the current account to overdraw up to the given limit. Purchasing and selling of the security. The bank offers you with the facility of selling and buying the securities. Locker facilities. Bank provides lockers facility to the customer to keep their valuable belongings or documents safely. Banks charge a minimum of an annual fee for this service, paying and gathering the credit. It uses different instruments like a promissory note, check and bill of exchange. Types of commercial banks. There are three different types of commercial banks. Private bank, which is one type of commercial bank where private individuals and businesses own a majority of the share capital. All private banks are recorded as companies with limited liabilities, such as Housing Development Finance Corporation, HDFC Bank, Industrial Credit and Investment Corporation of India, ICICI Bank and Yes Bank. Public bank. It is that type of bank that is nationalized and the government holds a significant stake. For example, Bank of Baroda, State Bank of India, Dena Bank, Corporation Bank and Punjab National Bank. Foreign bank. These banks are established in foreign countries and have branches in other countries. For instance, American Express Bank, Hong Kong and Shanghai Banking Corporation, HSBC, Standard and Chartered Bank and Citibank, etc. I hope you would have understood what firms, insurance companies, investment banks and commercial banks and how they function. Thank you.